Investment income is basically money your money makes. The big buckets are interest, dividends, and capital gains. For this lesson, stay in the interest lane. Think bank accounts, money markets, CDs, bonds, and even notes receivable. On the EA exam, they'll often mix these together and ask you to identify what's actually interest versus something else. Interest is payment for the use of money. If you loan money to a bank through a deposit or to an issuer through a bond, you're earning interest. Most interest you see day to day is taxable, unless a specific rule excludes it. Exam tip: don't assume government means tax-free. Treasury interest is taxable federally. Municipal bond interest is the one that's generally excluded. Here's a classic EA exam trap: something called a dividend. That is not a dividend for tax reporting. Dividends paid on deposits or share accounts at credit unions, cooperative banks, and savings and loans are reported as taxable interest. So even though the customer hears the word dividend, you treat it like interest income, not qualified dividends. Most taxpayers first see interest on Form 1099 INT. A payer generally issues a 1099 INT when interest is $10 or more for the year. But here's the exam twist: even if you don't get a form, taxable interest is still reportable. Missing paperwork doesn't make income disappear. You're reporting the income, not the form. Now the Schedule B question. If taxable interest exceeds $1,500, you must list it on Schedule B instead of just entering a total on Form 1040. Schedule B is basically the IRS saying, show your work. Under that threshold, many taxpayers can report interest directly on the 1040 without attaching Schedule B. On the EA exam, they love that $1,500 cutoff. Quick workflow to keep you safe on test day. Identify the source, decide if it's taxable, then decide where it goes. If it's taxable interest, it lands on Form 1040, and if the total is over $1,500, you attach Schedule B and list payers. And remember the weird one: dividend interest from credit unions still follows the interest rules. Marisol purchased Series EE-US savings bonds 10 years ago. She cashes them in to pay for her son's college tuition of $10,000. She receives $7,250 from the bonds, $5,000 principal, and $2,250 interest. What portion is non-taxable? The choices range from only principal being non-taxable to the entire amount being non-taxable. Think about it. The correct answer is that the entire amount is non-taxable because it was used solely for her son's education expenses. This is the savings bond education exclusion concept. A tempting wrong answer is the one saying only principal is non-taxable because normally interest is taxable. But this question is testing the special education rule that can exclude the interest when requirements are met. Which type of interest income is not taxable to the recipient? Your options include interest on CDs, interest earned on a personal loan, interest from treasury bills, and municipal bond interest. Only one of these is generally excluded from federal gross income. Think about it. Municipal bond interest is the correct answer. It's generally excluded from federal income tax for regular tax purposes. The tempting wrong answer is treasury bill interest because people hear government and assume tax-free. But treasury interest is federally taxable. It's the muni interest that's typically exempt.